statement will walk through a question where we need to prepare a statement of changes in shareholders' equity. Dance Studios Limited is a public company and accordingly uses IFRS for financial reporting. The corporate charter authorizes the issuance of an unlimited number of common shares and 50,000 preferred shares with a $2 dividend. At the beginning of 2020, the opening account balances indicated that 25,000 common shares had been issued for $4 per share and no preferred shares had been issued. Opening retained earnings were $365,000. The transactions during the year were as follows. You can see we issued common shares, preferred shares, we issued shares in exchange for land. We declared and paid a dividend on preferred shares. We declared and paid a dividend on common shares. We purchased and retired 500 preferred shares. And then we're told that after preliminary closing entries, the income statement account had a credit balance of $232,000. And the first thing we're asked to do is prepare the journal entries to record the transactions above. All right, well, let's get started. So January 15th. So January 15th, we've got January 15th. We are going to issue 1,000 common shares at $6 per share. So 10,000 common shares times $6. This is going to give us 60,000. So we're going to have debit, cash, credit, common shares. For 60,000. That's this one. Then we're going to issue 2,000 preferred shares at $60 per share. So February 12th, we're going to issue 2,000 preferred shares times $60, which is going to give us 120,000. So we're going to have debit, cash, credit, preferred shares. Sorry, 120 and 120. Okay, then September 12th, we're going to issue 5,000 common shares in exchange for land valued at 25,000. So we are going to need to record the preferred shares at the fair value of the land, but we're not going to have debit cash. Now we're going to have debit land, credit, common shares. And this is going to be for 25,000. That one. October 1st, we're going to declare and pay a dividend on preferred shares at $2 per share. So let's go October 31st. We're going to debit dividend. We're going to credit cash. Dividend is a sub-account of our retained earnings, part of our shareholders' equity statement. So this is going to be for, how much was this dividend for? Common share, preferred shares, $2 per share. So we have 2,000 preferred shares times $2. So this is going to give us $4,000 dividend. And then we're going to declare and pay a dividend on preferred shares, on common shares at $1.50 per share. On November 1st. So we're going to have 40,000 common shares. We're going to have 40,000 common shares times $1.50. That is going to give us $60,000. Credit cash. It says we declared it and paid it. That's why we're putting it to cash and not to dividend payable. And then we purchased and retired 500 preferred shares at $62 per share, November 15th. So how much were the shares worth? So we purchased and retired 500 preferred shares, but we issued the preferred shares for the first time here at $60. So when we issued the shares, we issued them for $60. So 500 times 60, $60. This is going to give us 30,000. This is the amount we paid for the shares. And now we're going to buy them back for $62, which is going to give us $31,000 because there's 500 shares. So we're short $1,000, you can see. And that $1,000, we would check and see if we had anything in contributed surplus, which we don't related to preferred shares. So this is going to need to go through retained earnings. So our journal entry is going to be debit preferred shares. Because we have less preferred shares now, we're buying them back. And that's going to be the amount that we paid because that's the maximum amount we can take off of our statement of financial position. We can't have them go into a negative. Then we're going to have debit retained earnings of the $1,000 shortage that we calculated right here. And then we're going to have credit cash because we're paying back $31,000 for those shares. We're paying them back. We're buying back 500 shares at $62 per share. Okay, so we got that one. And this one here is a closing entry through retained earnings. So that's not something we need to journalize. So for now, we did everything for A. Next, it asks us to prepare the statement of changes in shareholders' equity. So because we are preparing an official statement, we want to make sure that we label it correctly. Sometimes there are points for this on exams. So we've got Dance Studios Limited. So we're going to go Dance Studios Limited, statement of changes in shareholders' equity. And it's a for the year ended or year ended December 31st, 2020. Because this statement is a continuity statement. So it's not like a balance sheet where it's at a point in time. This is a year-ended statement. So now we're going to create our columns. So we're going to have number of common shares. We're going to have the value of common shares. We're going to have the number of preferred shares. We're going to have the value of preferred shares. Then we're going to have retained earnings here. Sometimes we have totals down the side. We definitely need the total at the bottom, so we'll leave it at that for now. We're going to start this out by having the January 1st, 2020 balance. And we were given some of this information in the question. So we were told that there were the corporation unlimited no common shares. Okay. At the beginning of 2020, the opening account balances indicated that 25,000 common shares had been issued for $4 per share. So we know that we had 25,000 common shares and they were worth $4 per share. So 25,000 times $4 is going to give us $100,000 of common shareholders' equity. We're also told up here that no preferred shares had been issued and that opening retained earnings were $365,000. So we've got nothing here for opening. We've got $365,000 here. Okay, now we need to add the transactions that we journalized above. So the first thing that we did is we issued common shares and we issued preferred shares. So we can have those in the same line. We can have shares issued for cash because we're going to distinguish it from where we issued it for land. And we issued 10,000 common shares for 60,000. And we issued 2,000 preferred shares for 120,000. Okay, so those are the shares we issued. And note, we can put the common shares and the preferred shares on the same line because they're distinguished by the columns. We don't keep a separate line for each journal entry because this statement is meant to be condensed and it's combining the rows and the columns to make sure that the reader has all the information. Then we are going to issue shares for land. And we issued 5,000 common shares for $25,000 was the fair value of the land. Then we issued dividends on our common shares. And the dividend that we issued was $60,000. And it's really important to notice that that goes as a deduction from retained earnings because dividends will close out to our retained earnings account, even though we've recorded them to a dividend account. That dividend account closes to retained earnings. So that's why our dividends are reducing the retained earnings in this statement. We also had dividends on preferred shares. And those are going to be the same thing, 4,000 here. Then we had the shares purchased and retired. Purchased and retired. And that is going to take, we reduced 500 preferred shares. It reduced our value by 30,000 and it reduced retained earnings by 1,000. We also have net income. Now, where are we getting net income from? Let's take a look up in the question. Remember this amount that I said we didn't need to journalize, where it says after the preliminary closing entries, the income statement summary had a credit balance of 232. What this is this is how we close out our GL system. So this is basically saying that we have income year to date of 232, but we haven't closed it to retained earnings yet because we haven't closed out the GL. So that means, though, that in the statement of changes, of course, we're going to have net income of 232,000 because, of course, we're going to close that statement out. So what we're going to do then is we're going to have the balance, December 31st, 2020. And this is simply going to sum up each of these columns. So the number of shares total is 40,000. The value of the common share equity is 185,000. The number of preferred shares is 1,500. The value of the preferred share equity is 90,000. And the value of our retained earnings is 532,000. Of course, picking up the opening balance plus the impact of the transactions throughout the year. So that's what our statement of changes in shareholders' equity looks like. Okay, so we finished B. Then it says prepare the closing entries for the income statement summary and the dividends. This just means closing out the GL. So we're simply going to debit our income statement summary account and credit our retained earnings for the income. Meaning we're just moving the income from the income statement into retained earnings. We're closing it out. So when we start 2021, we are starting with an income statement at 0. It would be weird if we never moved that income over. Our income in 2021 would look way too high because we clear it out at each year end. Same thing with dividends. We used a dividend entry. That's going to clear to retained earnings. We're going to clear out that summary account. And this is just going to be for the $4,000 dividends on the preferred shares, plus the $60,000 dividend that we issued on the common shares. So this is going to be just the total of $64,000. And that takes us through part C. and concludes this question.